They say only two things in life are certain: death and taxes. But there's a third thing you can count on every few years or so. The central bank put interest rates. On life support, they fall into what they call a rate-cutting cycle. And right now, they're doing it again. This is bad news for you. In this video, we explain why interest rates are falling, but not for your benefit. Here's the problem. Central banks want you to borrow more money, but not so you can get ahead. Instead, they want to keep the financial system on life support because it's broken. Lower interest rates mean you could borrow more money each month. Take mortgages. For example, if you borrow $400,000 at 6%, you'll pay about $2,400 a month. But if rates drop to 3%, that same mortgage will cost you just $1,600 a month. That's a pretty big difference. When rates are low, people borrow more money because they have extra cash flow from that cheap debt. Then they use that cash flow to buy stuff like vacations, new cars, or houses. When they take out a loan to buy a house that benefits the seller of that house. In other words, when interest rates go down, everyone who owes money gets richer, while everyone who saves or lends money becomes poorer. Companies are no different. A few months ago, JP Morgan, one of the largest banks in the world, bought back $1 billion worth of their own shares. Here's how that works. JP Morgan borrows money by issuing bonds. People or other companies buy those bonds. By buying the bonds, they're essentially lending money to JP Morgan. Now, JP Morgan uses that money to invest in things like houses, office buildings, and government bonds. They earn interest on those investments and then pay you back with the interest you lent them. If interest rates are low, borrowing money is cheap. So instead of lending it out, JP Morgan buys back their own shares. It's kind of like giving money to your old folks so they can buy a new car. Sounds nice, except it doesn't make any sense. Buying back stock does not make a company stronger or grow the economy. It just makes some shareholders wealthier. And guess who those shareholders are? Well, most executive compensation comes in the form of stock options. When the stock price goes up, their compensation goes up. So executives have an incentive to rig the game so they can borrow cheap money, buy back shares, and pad their own pockets. But don't worry, it's not illegal. It's actually encouraged by the very same people who claim to be looking out for you. In fact, the whole financial industry is rigged to benefit people who borrow money. Take this chart. For example, it shows the total amount of household debt in America. Household debt includes mortgages, student loans, credit cards, and auto loans. In other words, it shows how much money people owe. Do you see what happens during a recession? Debt goes down. When people lose their jobs, they have less money to spend, so they pay off more of their debt. But after recessions, something interesting happens. People start taking on more debt. The economy might be recovering, but that's not the real reason. People don't want to pay off debt. They want to take on more debt. Here's why. Low interest rates after a recession make it really cheap to borrow money. So people take on more debt. They know that if they wait too long, interest rates could go up, making it more expensive to borrow. So they rush to refinance their mortgages, buy new cars, and go on vacation. All of this spending keeps the economy running, which is why central banks love it. It's the same story with retirement funds. When interest rates fall, it means your savings is earning less money. What's worse is that many retirees rely on their savings to pay for their living expenses. It's their only source of income. When interest rates are low, these people simply run out of money faster. Some are forced to sell their homes to pay for food and medicine. It's tragic, but it's happening to millions of people around the world. What about Japan? Their central bank has been keeping interest rates near zero for decades. The Bank of Japan has been buying government bonds since the 1990s. They thought this would help the Japanese economy recover from a recession, but instead, they created a bubble. If you buy enough assets, their price will eventually go up. The Bank of Japan realized this and stopped buying bonds in 2011. But the damage was done. Japan still has one of the biggest bubbles in the world today. You can see it in this chart here. It compares the value of Japanese government bonds to their yield. In simple terms, Bond prices and yields move in opposite directions. So if you lend money to the Japanese government, you'd expect to earn a high interest rate. But look at what's happening here. Yields are at record lows, despite bond prices going through the roof. The only way this is possible is if people are willing to lend money for free. But why would they do that? Because they don't trust the Japanese economy. People think that the government could default on its debt, so they lend their money for pennies on the dollar. Negative yields are a sign of economic trouble. Investors aren't getting paid to lend their money. Instead, they're paying the government to take it. That's why central banks around the world are rushing to cut interest rates. They want to make borrowing cheaper before investors demand higher yields, signaling that something is wrong. That's why interest rates are falling, but not for your benefit. All of this brings us to the final piece of the puzzle: a $1 trillion deception. It's the reason why so many people are completely unaware of what's happening. Just a few weeks ago, Jerome Powell spoke about inflation. He said it is a global problem and that the Fed needs to raise interest rates to fight it. But is that true? Take a look at this chart. It shows the U.S. Consumer Price Index. You can see the price increases in different colors. For example, this orange line shows the cost of energy. This blue line shows the cost of airline tickets. Look at the price increases over time. In recent months, almost everything has gone up in price. Energy is up 35%. Airline tickets are up 40%. Used cars are up 37%. And food is up 12%. The overall level of prices is also going up. But take a closer look at the dates. Prices have been going up for the last 25 years. Inflation isn't a new problem. We didn't start seeing double-digit inflation in the 1970s. It's been happening for decades. If you ignore the data, you won't realize that you're losing money every single day. You'll think that you're winning, but the truth is quite the opposite. A few weeks ago, something very strange happened. Two big companies released their quarterly results. The first one is called Carvana. They're an online car dealer. In the last quarter, they lost $330 million. But here's the funny part. Despite losing hundreds of millions of dollars, their stock went up 15%. Their market cap is now over $80 billion. Take a look at this chart. It shows the company's revenue and net income. Revenue is the top line. Net income is the bottom line. As you can see, revenue is growing nicely. But something is very wrong with the company's net income. It's not just that they're losing money, it's that they've been losing money for years. At this point, it's not a surprise that they're losing money. It's actually surprising that their stock hasn't collapsed. But Wall Street loves companies like this. As long as the stock price keeps going up, they don't care if the company is profitable. Carvana is not alone. Take a look at this company called Robinhood. They're a stock trading app. In the last quarter, they lost $299 million. But here's the crazy part. Their stock went up 18% despite losing hundreds of millions of dollars. These companies don't deserve to exist. They're not adding anything to the economy. They're just transferring money from one pocket to the other. If you lend money to Carvana or Robinhood, chances are you'll never get it back. The only reason they exist is because the central bank keeps printing money. Every time you hear about another rate cut cycle, you should be worried. Don't get sucked into the trap.